Okay, welcome to Technical Analysis Part 2. Now let's go one step further to understand the different types of trends in different time frames. For example, if this were to be, for example, a 5-year time frame, what would you say is a trend? Well, most people say the trend is up. Yes, it's an uptrend, only on the long-term time frame. So long-term means to say 5 years or more. So this is a long-term uptrend. So there are certain stocks which are on a long-term uptrend, like Apple, for example, or McDonald's, or the S&P 500 index. These are all on long-term uptrends. But it doesn't mean that you can buy them at any time on this uptrend. Because within that long-term uptrend, you also have what we call medium-term trends that last between 6 months to a year. So this is, for example, a medium-term downtrend within a long-term uptrend. So people who are very long-term investors, if they believe a lot in the company, they just buy the stock and close their eyes. Okay? Now I tend to be quite impatient. I don't like to lose money even in the medium term or short term. I like to always make money. So as a result, I never like to buy even on a medium-term downtrend because it can still go down even up to 25, 30% before advancing up again. But notice again that within a medium-term trend, prices don't go up in a straight line. They go up and down and up and down and up and down. So within the medium-term uptrend, you could also have what we call short-term trends. Okay, so the short-term trend could last 1 to 3 months. So again, it's a short-term downtrend on a medium-term uptrend, so on and so forth. So it depends on your time frame. For me, I'm kind of a very short-term investor slash trader. So I only like to buy when the short-term trend is up and the medium-term trend is up and the long-term trend is up. Only when all are up do I go long, because I don't like my stock to go down even for a couple of days, right? Now, what you've learned in the last part of this video was the 50 and 150-day moving average and the 200-day moving average. That moving average technique tells you the change in the medium-term trend. However, if we want to also capture the short-term trends, we use a shorter-term moving average. And we can use the 20 and 40-day exponential moving average, or EMA. And the way it works is the same as the 50-150 crossover. So this is the skinny man, that's the fat man. There's the red line, there's the blue line. It's as simple as when the 20-day, the red line, cross above the blue line, that's a short-term uptrend signal, and that's a long entry. So we buy over here. When the 20 crosses below the 40, it's a short-term downtrend, and we want to sell over here. And again, when the 20 crosses back above the 40, we buy it back again. When the 20 crosses the 40, we sell it again. So there's a buy signal, sell signal, buy signal, sell signal. So how do the two techniques compare? Well, once again, the 50, 150, and 200-day moving average identifies the medium-term trend. Now, when you use this technique, there's a higher probability of you having a profitable entry. On average, if you use it on indices and ETFs, the profit rate or success win rate can be as high as 80-90%, because ETFs tend to have very smooth trends. If you use it on stocks, some stocks are more volatile than other stocks, but on average, you get a win rate of about 66.7%, which means out of 10 entries, you find that roughly about 6 of them will lead to a profitable trend. 4 of them will be not really profitable. You may even lose money. But then again, you still make money if you are able to get out when the trend changes and you cut your losses short, let your profits run. If you purely use the 50 and 150, you get less buy and sell signals. You get roughly a signal once every 6 to 8 months. Using the 20-40-day EMA, you identify the short-term trends. Now, if you use this alone, the probability of a winning trend is only about 43%. That's why I don't use it alone. I tend to combine this with this to get an even better result than what this can provide. And I'll show you in a short while. The 2040 EMA gives you more buy and sell signals. And if you combine both techniques, you get a much higher profit return on the average. So how do you combine the both techniques? Now, what I do is this. Personally, I only go long when the medium-term trend is up and the short-term trend is up. So in other words, the 50 is above the 150, or the candles above the 200-day, and the 20 must be above the 40 EMA. Then I'll go long. That tells me I've got a very high probability of upward momentum. So take a look at this chart over there. Now notice that the 20 crossed the 40 over there. Okay? So normally the 2040 signal will come first because it's a short-term signal. Then the 50 crosses the 150 over there. The medium-term trend signal comes in. So I want to wait for both signals to happen. So when the 50 crosses the 150, that's my entry point. Because the 20 has already crossed the 40. So I buy over there and I ride the trend signal all the way up. Now, you can decide to sell for profits when the 20 EMA crosses below the 40 EMA, even though the medium-term trend is still up. So let me give you an example. As you can see, this entire stock is on a medium-term uptrend. The 50 is above the 150, right? They are both sloping up. Candles are above the 200-day moving average. So it's on a confirmed medium-term uptrend. So I could have bought somewhere here when the 20 was also above the 40. Now notice at this point of time, the 20 crossed the 40, signaling a short-term downtrend. So you could sell over there. But you may say, hey, it's only a short-term downtrend. It's still on a medium-term uptrend. So again, people who are more medium to long-term, they may not want to sell here. But for me personally, my personal style is I will sell there. And if the 20 crosses back above the 40, I'll buy it back again over there. Now, why do I do this? You may say, hey, by buying here, or rather by selling here and buying it back, don't I sustain a loss over there? Yes, I do. But you know what? I'm buying insurance just in case it went a lot lower. Okay? So I'd rather take a small loss over here and buy a bit of insurance to make sure that I don't sustain a bigger loss. So I'll sell here and buy back here once again. Again, when you make an exit, when the 20 EMA crosses below the 40 EMA, it helps you to maximize profits and minimize losses. Here's a good example of Bank of America. Notice the 50 has crossed above the 150, right? So that's a buy over there. So imagine you buy $8 and it goes up all the way to $10. You make a $2 profit, you're really happy. But suddenly the trend changes and it goes down, right? And can you see the 20 crossing the 40, telling us a short-term downtrend? So I would sell over there. So notice I buy at $8 and I sell at $8. So I break even, okay? But if you wait for the 50 to cross the 150, by the time the 50 crosses the 150, signaling the medium-term downtrend, by that time, the price may be about $6, which means you'll make a $2 loss. So I rather lose nothing over here, just on commissions, by selling when the 20 crosses the 40. And if it happens to reverse back up again, I buy it back again. Now, if you go long when the 20 EMA crosses above the 40 EMA, in other words, if you go long when there's a short-term uptrend, but the medium-term downtrend is still down, notice that it is still highly risky. Now, sometimes I may do that, okay, but more often than not, I don't do that because the probability is very low that you'll succeed. So here's an example. Notice for Cisco, it's on a medium-term downtrend. How do we know? Because the 50 is below the 150, right? Can you see the blue line is below the green line? So this is a confirmed medium-term downtrend. But notice that there are short-term uptrends where the 20 cross the 40 over there, 20 cross the 40 over there. Now, if you buy purely when the 20 cross above the 40, notice that by buying it failed. By buying it failed. By buying it failed. And you have made 3 losses over there. And that's why we want to avoid buying even when the 20 cross above the 40. As long as the medium-term downtrend is down. So here's a table to summarize the 2 kinds of trends and when to take an entry. In summary, when the medium-term trend is up and the short-term trend is up, I tend to go long. When the medium-term trend is up and the short-term trend is down, I tend to sell for profits and buy it back when the short-term trend goes up again. Now, when the medium-term downtrend is down and the short-term trend is up, I consider a high-risk long entry. Sometimes I may go long, but again, most often than not, I will avoid it because it's better to hold and wait. Now, when both the medium-term trend is down and the short-term trend is down, that's a confirmed downtrend. You never want to go long. In fact, if you're the type that likes to go short, that's the time to go short. Okay? So again, how do you tell the medium-term and the short-term trend? Using the 50, 150, and 2040. Do note also that the prices above the 200-day moving average signals an uptrend, and prices below the 200-day signals a downtrend. So you can also use that as well.